Welcome to the MUFG Global Markets Podcast. I'm John Cook, and I'm joined today by Takahiro Sekido, Chief Japan Strategist for MUFG. It's Monday, June 13th, 2022. Welcome back to the podcast, Sekido-san.
Good to be back.
Always good to have you. And you have been putting out a ton of research as of late. Before we get to some more recent developments and significant ones, why don't we take our listeners through changes to Japanese life insurance company asset management portfolios as described in their recently released fiscal year 2021 earnings?
Okay. The major Japanese lifers reported higher insurance income in fiscal year 21 as sales rebounded after the COVID crisis. In fiscal year 21, 9 lifers held 191 trillion yen in securities assets under management, up 2% year over year. This included 77 trillion yen of JGBs, up 5% year over year. 14 trillion yen of Japanese corporate bonds, down 4% year over year. 49 trillion yen of foreign bonds, down minus 0.7% year over year. 18 trillion yen of foreign stocks, up 14% year over year. And 22 trillion yen of Japan stocks, down 3% year over year. Japanese lifers hedged 64% of their securities portfolios for currency risk, 57% of dollar assets, and 87% of euro assets. In fiscal year 21, lifers increased their holdings of first, JGBs, second, foreign stocks and investment fund holdings, and third, currency swaps. In a transition of their accounting standards, they maintained their durations, especially with super long JGBs at the end of the fiscal year, took base profit with FX hedged credit instruments investments, and limited FX risk in managing their positions. Lifers diversified their assets from straight foreign bonds to include also foreign stocks and investment fund holdings. Their investing behavior in fiscal year 22 will not change much from in fiscal year 21 and contribute to keep yen rates neutral and yen basis widening.
Yeah, that's interesting. And this is stuff that you've been talking about really all year, but the sort of steepening and sell-off of the JGB curve, not surprising to see them transition, kind of transition back into JGBs. And you've been, speaking about them looking to increase alternative assets. So that all very much makes sense. Switching topics, slightly, but also to kind of stay on this cross-border flow topic, the April and May balance of payment data was recently released by the Japanese Ministry of Finance. What does it tell us about Japanese investor activity, overseas, as well as foreign investor activity in Japan over those 2 months?
Okay. Japanese investors' overseas investing slowed in unloading foreign securities by a net 468 billion yen in May. They slowed in unloading foreign bonds by 1 trillion yen. Overseas investors net bought 3 trillion yen of Japanese securities, including 3 trillion yen of short-term bonds and 731 billion yen of medium to long-term bonds. Japanese investors contributed to unload foreign bonds, but at a slower pace, while foreigners rebuilt their JGB holdings, especially with TDBs. Since the start of fiscal year 22, both Japanese and foreign investors alike have faced interest rate risk with their G10 bond portfolios and being hit with sudden changes in hedging costs, and they have been forced to reshuffle their G10 bond positions. Overseas investors have quickly returned to buying JGBs and accumulating TDBs since April, after the JGB redemptions of March. On the other hand, Japanese investors have started to cut and reshuffle their foreign bond holdings since February. Over the near term, the Ministry of Finance plans to cut the issuance of TDBs. Because of this, foreigners have turned towards the belly, alleviating upward stress on JGB yields. Japanese investors have the potential to be stabilizer for the US corporate bond market. We feel that it will be important to carefully study the US TIC data to see if Japanese investors focus on US corporate and government agency bonds and help to stabilize the overall dollar bond market.
Okay, so up to this point, more recently, foreign investors have been good buyers, and so they've alleviated some of the sell-off. So it'll be interesting to see if that continues. Whereas we're still waiting to see if Japanese investors kind of step in and support, foreign bond markets, particularly in spread product. So kind of now to the main event, if you will, of the podcast. So we're on an administrative note, we're recording this podcast on Monday, June 13th in the afternoon of the U.S. session, and what a session it's been. Not to exaggerate, but 10-year treasuries have sold off something like 20 basis points. The market's just gotten absolutely destroyed. The Wall Street Journal reported that the Fed is likely to hike 75 basis points at this week's policy meeting. So I think the question is, what's the BOJ going to do? So you put out a preview late last week. Perhaps you could take our listeners through the high points and then update it for some of these recent developments.
Okay. The BOJ will hold this month's Monetary Policy Board meeting on June 16th to 17th, and we expect it to keep monetary policy unchanged. We expect the BOJ to carefully examine the conditions out of the release of June Tankan Survey July 1st and the upper house elections July 10th. Any policy changes will likely be made at the July meeting. Governor Haruhiko Kuroda was forced to backtrack on remarks last week, so his comments will be closely watched at a post-meeting press conference. However, Governor Kuroda will carefully explain policy arrangements and his current views as he did in April. Over the near term, attention should focus not on the long end of the JGB yield curve, but rather on the front end, based on any changes in BOJ policy. The BOJ's COVID countermeasure operations outstanding balance stood at 74 trillion yen at the end of May, reflecting a steady decline. But it is unlikely that the BOJ will make any changes to its overshooting style commitment halfway. The BOJ will continue to support changes in corporate behavior by focusing on both climate change operations and a lending support program. However, overnight, 10-year JGB future dropping. So as a risk scenario presently, the BOJ may modify slightly its overshooting style commitment to reach 2% inflation target and decrease the monetary base to mitigate the present yen weakening pressure.
Okay, so it looks like your base case view is that policy changes are likely to be made at the July meeting. However, developments today, and arguably Friday, kind of may change that such that the risk scenarios that you potentially see changes at this week's meeting. Is that correct, Sekido-san?
Yeah, that's correct. Yes.
Okay, great. Thank you. That's very clear. So, why don't we do this? Let's look at the market implications of all this, and why don't you give our listeners your outlook across yen rate, spot dollar yen, and yen cross-currency basis markets?
So dollar yen has been more sensitive to oil prices than to the US-Japan yield gap of late. The Bank of Japan's policy has increasingly diverged from other central banks, so weakening the yen. If the yen weakens past the 10-year low of 135.20 marked on January 31st, 2002, the next stop after 137.25, the level of September 24th, 1998 will be 140. We see the dollar yen trading in a higher 3-yen range between 133 to 136 and change our view of the bias from neutral to bullish. If the yen weakening further above 136, the BOJ has to consider to modify its overshooting style commitment. I do not expect any currency intervention at this stage by the MOF, as other G7 countries are unlikely to cooperate with Japan's currency interventions. The yen swap rate curve has steepened. Yen basis has been widening in the valley, and more the foreign investors are expected to join in. The MOF is reducing the issuances in its TDB auctions, and the JGB yield curve is likely to steepen over the near term. We'll be watching if the BOJ boldly holds JGB buying operations to stem the upward pressure on the long end of the JGB yield curve. Governor Clover is battle-hardened, so may not give up quickly and will maintain the yield curve control operations. We see a neutral bias for 10-year rates as the BOJ continues to buy unlimited amount of 10-year JGBs. Non-10-year JGBs will continue to have an upward bias this week. The yen basis curve is steepened in tandem with yen rates. According to the Ministry of Finance weekly securities flow data, Japanese investors turned net seller of foreign securities by 132 billion yen between the May 29th to June 4th. They unloaded a net 840 billion yen of medium to long-term foreign bonds and a net 30 billion yen of short-term foreign bonds, while net buying 738 billion yen of foreign stocks and investment fund holdings. Japanese have been unloading more foreign bonds. Over the near term, Japanese could unload more foreign bonds, depending on circumstances at individual companies through the general shareholders meetings at end June, regardless of monetary policy at G10 central banks. Foreigners net bought 1.5 trillion yen of Japanese securities over the same week. This included net buying by 1.5 trillion yen of short-term yen bonds and 59 billion yen of medium to long-term yen bonds, against 122 billion yen net sold of Japanese stocks and investment fund holdings. Foreigners' appetite for JGBs has been robust, especially on the front end of the yield curve, while Japanese direct overseas investing and foreigners' yen samurai bond financing have helped yen basis widening. But strong demand for TDBs among foreigners has clearly contributed to the front end of the curve tightening. We now see a widening bias for yen basis rather than neutral.
Wow, there's a ton there, but just to kind of summarize, bullish on dollar yen for good reasons, neutral on the 10-year part of the JGB curve as the BOJ continues to buy an unlimited amount of bonds, of the at least of the first of the three on the run issues, and a widening bias across dollar yen, and a key Bank of Japan policy meeting coming up this Friday after, of course, we get the Fed and the BOE, and again, all eyes on the BOJ on Friday, as my JGB trader mentioned. In 2006, Kuroda denied considering negative interest rates, about a week before the BOJ meeting, where they did in fact announce negative interest rates. So really couldn't be more going on this week. So Sekido-san, we really appreciate you being on the podcast to preview all this for us.
Okay, thanks for having me, John.
And thank you for listening to the MUFG Global Markets Podcast. Rate, review, and subscribe on Apple, Spotify, or wherever you get your podcasts. And reach out to your MUFG sales rep for any further information. Check back soon for more insights from the Global Markets Research Team.